planning between 90 minutes to 2 hours for us to get full value for this webinar. Shortly we'll be having the opening protocols. Then we have opening remarks by our chairman, Dr. Samuel Abe. Then we'll have introduce our guests, and our guests will deliver the paper. Afterwards, we'll have a question and answer session. Then we'll have closing remarks. That will be just a quick rundown of the program lineup for this day. I'll hand over to Elder Yenuga to continue so that we can start in earnest. Thank you.
Good morning, all. It's a pleasure to have all of you here. Can you hear me, please? Hello?
Yes, we can hear you.
Thank you very much.
We can hear you, sir.
Yes, we are in a webinar that we intend to discuss a very important topic to the members in practice. And our able paper presenter is Dr. Chinedu Uchechukwu of Ernst & Young. I've been trying to get him now, even though we spoke this morning and he said he will log on at exactly 11 o'clock. But I've not really seen him on this something. Okay, yeah, he's there now. He's there. Dr. Uchechukwu. Yeah. Dr. Uchechukwu.
Yes, I'm here.
Thank you very much for joining us. You are welcome on board. This is IGDS, the model district, and we also thank you for accepting our invitation to present this paper. I want to quickly run on the profile of our paper presenter, Dr. Chinedu Uchechukwu. Dr. Chinedu Uchechukwu is a director in the assurance service line at Ernst & Young. He is responsible for IFRS DEX and sustainable reporting in Nigeria and across Africa. He is a business leader with over a decade of experience in professional practice. He has served numerous audit clients ranging from portfolio of large listed and multinational entities across various industries in Africa. His qualifications include the following. He has a BSc in accounting from Madonna University, Nigeria, MSc in accounting from University of Nigeria, Nsukka, PhD in accounting from University of Nigeria, Nsukka. He is a member of the Chartered Accountant of Nigeria and has contributed to professional practice in Nigeria in the following areas. He is a member ICAN Professional Practice Committee from 2022 to 2024. ICAN Professional Examination Committee from 2024 to date, and a member Accountancy Sectors and Members Conduct Professional Development Committee from 2021 to date. He has published numerous scholarly and business articles and is also a regular facilitator at ICAN programs. Dr. Uchechukwu, you are welcome. Dr. Uchechukwu will be talking on auditors' independence and financial integrity in audit practice, challenges and implications to auditors. I'm sure with his wealth of experience, he will be able to break it down into granular, all our challenges and what we intend to hear from him as a professional practitioner. Thank you very much. Dr. Uchechukwu, the ball is in your court.
Thank you very much. I'm going to start sharing my screen.
Okay. Good morning, everyone. Dr. Chinedu, you are welcome.
Thank you. Good morning.
Yeah, before you start, let me quickly give the opening remark. I think we jumped that. Yeah, sorry for that miss up. Good morning, dear professional colleague. You are all welcome to this special webinar organized by our team of membership and practice. On behalf of the district leadership, it is my distinct pleasure to welcome you all to this timely and important webinar on auditors' independence and financial integrity in audit practice. We are looking at challenges and implications to auditors. We are gathered here today virtually on Zoom, yet united in purpose to reflect on the critical issues that lies at the very heart of our profession. In an era where public trust is fragile and accountability is paramount, the role of the auditor has never been more crucial, no more scrutinized. This webinar presents us with an opportunity to engage in thoughtful dialogue, explore real-world challenges, and discuss practical pathways for upholding integrity and independence in our audit practices. I encourage each of you to participate actively, share insights, ask questions, and take away knowledge that will strengthen our professional journey. I commend the team of the membership in practice and our resource person, Dr. Chinedu Uchechukwu, ACA, a director in EY, Nigeria, for their commitment to advancing audit excellence. Thank you all for being part of this important conversation. And I will also like to thank the chairman of Surulere and District, who happened to be the pioneer chairman of this committee. I think is present on this platform today. Thank you so much for pioneering this call. Once again, welcome, and I wish you all a productive and enlightening session. Thank you, and God bless. So to my Oga, Dr. Shinedu, you can go ahead with the presentation. Thank you.
Okay, thank you very much, Mr. Chairman. And let me also, in a special way, thank the leadership of the district for extending the invitation to me. At the time when this invitation came to me, I was not a member of the IGDS, but after the invitation came to me, I eventually joined IGDS. So I'm currently a member of IGDS as we speak. So
thank you so much. You're welcome.
Yes, I transferred from Enugu and District Society to IGDS. Yes, so and I'm happy to be with us this morning to discuss this important topic, auditors' independence, focusing on the challenges and implications. I want to believe that everybody on this call are members in practice, but even if you are not members in practice, maybe you're also probably in employment, but practicing, or you have some knowledge of practice. We are going to, as much as possible, make the conversation to be very practical. So we have instances where I would require you to perhaps unmute yourself and make some contributions. So we want it to be a little bit, very much practical based on what we see currently in practice. So we will start with looking at introduction, background to what auditors' independence is all about. And then we'll also look at challenges and threats to auditors' independence. Then we will discuss financial and non-financial relationships. We'll look at regulatory matters and compliance matters, and then we'll look at also technology advancements and innovations, and then we'll discuss stakeholders' expectations before we'll be able to eventually conclude. So starting with introduction, by way of introduction, when we talk about auditor's independence, we are basically referring to the ability for the auditor to make a decision without bias, to make an unbiased decision. There's something I'm trying to do. I want to get highlighter. Okay, lesser point. Okay, that's fine. All right. So we are referring to the ability of the auditor, being able to render their service, their audit service, in an unbiased manner, such that the auditor is able to reach a reasonable conclusion and form an opinion without bias. And there are certain things that are likely to make the auditor not to reach that reasonable conclusion, or not to be able to form that opinion, right? That unbiased opinion. Some of these things are issues that affect independence. So independence is essentially the ability for that auditor to make that unbiased decision and be able to form an opinion objectively, right? So if the auditor is able to do that, we say that the auditor is independent. So independence is actually a critical part of the audit process. Every external auditor is expected to be independent, and it is linked to the main fundamental principles, which is being able to act objectively and act with integrity. Now, from the professional code we have, issued by ISBA, which is the International Independence Standards, independence is approached from two perspectives: independence of mind and independence in appearance. For independence of mind, you are looking at the ability to reach an unbiased decision, ability to conduct yourself as an auditor to reach an unbiased decision objectively, all right? Even if you're not seen as doing that, within you, you are objective, and you have documented your objective reasoning, and you've been able to reach that conclusion. So all documentations, all your actions point towards that direction, that you are independent. But independence in appearance is actually focusing on perspective or perception of stakeholders around you to determine whether you are indeed independent or not. So, for example, you are the auditor of a client, right? Let's say the client is, the client's son is organizing a wedding, and then I attended that wedding, and I am seeing you as the auditor at that wedding, as the chairman of the occasion at the wedding, So seeing you there, because I know that you're the principal or the engagement partner responsible for that audit, and I'm seeing that the person organizing the wedding, the host, is actually a director in that company. So when I see both of you there, I would not be able to reach that conclusion that you are independent, because you don't appear to be so. Even if within you, you must have followed all the processes to make sure that you're independent. But from the perception or the perspective of the stakeholders, seeing you, you don't appear to be so. So for independence to be complete, first of all, you must be intrinsically independent, and you should also appear convincingly to be independent. And you must desist yourself from every action or every matter that could suggests that as an auditor, that you are not independent. So, and from the audit perspective, the audit team is expected to, comply fully with the fundamental principles, issued by ISBA to be able to maintain that independence. Now, from historical standpoint, independence, the conversation about auditors being independent actually started, due to a lot of financial crisis. I think the most recent one we all know is the conversation around the WorldCom issue, all right, in the United States. Now, all of these financial crises and scandals that have happened over the years actually led to the conversation about auditor being independent. And not just that, they also led to tightening the independence standards such that we are sure that auditors, after complying with those standards, are able to maintain that independence. So they're able to objectively, and then of course with integrity, discharge their duties as auditors. Now, I've talked about fundamental principles or codes that accountants are expected to comply with. And these codes, they are closely related to independence, because when some of these codes or these fundamental principles are impaired, ultimately independence is also impaired. So I would like to hear from you. Though I know you know them, but can anybody tell us those fundamental principles, and if possible, maybe highlight the key ones that work closely with independence? Or you can use the chat button. I think I'm looking at the chat button. If you don't want to unmute yourself, please, can you use the chat button? And yes, I've seen one from Abubakar. Objectivity, yes. Integrity, confidentiality. Judith said integrity and confidentiality, yes. Emmanuel, integrity, yes. So I think we have a very good idea of what we are referring to. Yeah, I'm seeing professional behavior. So we have very good idea of what we are referring to. Now, when we are talking about fundamental principles, I want us to focus on three key principles, because these are the principles that are usually impaired whenever independence suffers. Of course, we have other ones as well, all right? But then these are the key principles that usually suffer. And the first one is objectivity. As an auditor, you should be able to carry out your responsibility by being objective. You must be objective as an auditor. And being objective means that you're able to make unbiased judgments and be able to make unbiased decisions during the audit process. All right? And then as an auditor, you must be honest and you must be forthright. That is being able to, discharge your duty in such a way that you are truly honest, all right? So when you see something, you're able to raise those matters, because you have a lot of stakeholders that trust you as the auditor. So many stakeholders trust what you do, and they want to see you, be as much as possible transparent throughout the audit process. So integrity is a key principle that an auditor must comply with during the engagement performance. Then the next one is professional skepticism. As an auditor, you must have that inquiry mindset. All right? Anything you see, every information should put you on inquiry. All right? You don't outrightly take responses from the client or take audit evidence from the client without subjecting it to further tests. So as an auditor, you should critically assess every evidence you receive, and you must remain questioning throughout the audit process. In fact, if there is anything like second guessing every information you get, so that's basically what it is, being able to second guess, being able to put yourself on inquiry and always doubt. You're not doubting because you want to cause a problem, but you're doubting because you want to get objective information. You want to get to the truth. So as much as possible as the auditor, professional skepticism is a fundamental principle, is a key principle you must have, right? And then what we are saying is that if you want to maintain that independence, you should be able to be objective. You should act with integrity, and you must exercise professional skepticism throughout the audit. Now, when any of these principles, key principles, are impaired, it could be as a result of one threat or the other. So we're going to be discussing those threats subsequently. But these principles are as a result of what we have from, independence, from international independence standards issued by ISBA, all right? So here locally, we also have our audit regulation issued by the Financial Reporting Council of Nigeria. We are going to subsequently, we're going to look at the provisions of that audit regulation in this session, and then discuss how they affect long association and partner rotation to be able to maintain that independence, all right? Then another standard that can guide a firm to make sure that they comply with independence is their own independence policies. Every firm is expected to have independence policy. That independence policy will set threshold for reporting matters, will set the guideline an individual is expected to comply with, all right, for the individual to work in that firm. For example, a firm might say that if you receive a gift from a client, you are expected to report this gift. Some firms will tell you that if you receive a gift that is above a certain threshold, you should report the gift, or you should discuss it with the engagement manager or the engagement partner to determine whether or not the gift could cause or could give rise to threats to independence. So all these can be as a matter of firm policy. So firms can set some of these policies, but any policy you must set as a firm should be in compliance with international independence standards issued by ISBA. Because the Audit Regulation 2020, which was issued by the Financial Reporting Council, states that every auditor in Nigeria should comply with the ethical code issued by ISBA, in addition to international independence standards. So that's why every aspect of the international independence standards, especially with respect to the delivery of audit and assurance engagements, are applicable to us as auditors. Now let's discuss challenges. Having given a background to what independence is all about, let's look at challenges and threats to auditors' independence. Those matters that could make us not to be able to exercise or comply with those independence requirements fully. So maybe I'll ask you again, if you can tell me, as an auditor in practice, perhaps you've been executing your engagements for some time, what are those challenges you have faced in the process of complying with independence requirements? What are the challenges you have faced as an auditor while trying to comply with independence requirements? Anybody? You can use the chats or you can unmute yourself and speak. Feel free to unmute yourself and speak. Remember, we said we want the presentation to be as practical as possible. Yeah.
Thank you, Dr. Chinedu. So one of the challenges that we as auditors face is also management override of controls. When management, interfere in audit findings in order to manage either the reports or even ask for outright deleting of the exception or the audit observation. So yeah.
Okay. That's fine. Thank you very much. Any other suggestion, any other contribution from anybody? Any other contribution from anybody? Okay, I'm seeing a chat. I am an internal auditor. Why enforcing compliance to company policies, HR deprives us of some benefits. Okay. Okay, that's fine. Though this conversation is from external audit perspective, but I understand the perspective you have also come from. All right, so let's make progress. So we'll start with threats first, and then we'll look at other challenges. At least these threats are the ones that have been carefully identified by ISBA as the threats we are likely going to meet while executing our engagements. And these threats to fundamental principles, they also impair independence. The first one is self-interest. All right. And this self-interest arises when you, as an auditor, when you have financial interests in a company, and at the same time, you want to carry out the audit of that company. So when you do that, it's going to compromise your objectivity. You would not be able to be objective. So imagine that you are the auditor of a client and you have bought shares from that client, all right? Or that means you're a shareholder in that client and then you become the auditor. So in firms, bigger firms, right? The process is that you are expected to disclose all your financial interests. So every audit professional, at least from manager and above, is expected to declare their financial interests in every organization. So if you have shares in Dangote, you have shares in UBA, you have shares in Zenith, you have shares in any, no matter how small, even if it is just one share that you have, all right, you must disclose it. By disclosing, I mean, we have a tool. So in that tool, you go there and register or log it in that you have so and so shares in this client or in this company. Whether the company is your audit client or not, just disclose all the shares you have. You don't need to disclose the amount, right? All you just need to disclose is that I have interest in this company. So when you do that, the system would automatically register all the financial interests of their employees, of the audit employees, including that of the engagement partner. All the financial interests would be registered, such that if you're preparing to bid for a client, at the point when you're preparing to bid for that client, the system will automatically flag it. In fact, the system would do a search of that client and their related entities. So let's say that you're bidding for a company and the company is a member of a group of companies. You don't have interest in that company directly, but you have interest in the parent entity of that company. The system will automatically flag it to say that, hey, there is a threat to independence. So why it is good is if you have, if you identify that threat, that self-interest threat, you then focus on it to see whether you can either eliminate the interest if you are interested in carrying out that audit, right? If you are interested in carrying out the audit, then you start looking for what to do to that your financial interest. So either you eliminate, if elimination is possible, or you reduce it to acceptable level. All right. So you can either consider to eliminate the threat, or you reduce the threat using an appropriate safeguard. Okay. So this is what is expected when there is self-interest threat. And in practice, I can tell you that this is something that have affected so many people in their career. It has affected them because they don't take financial interest serious. All right. So you see sometimes when people have financial interest in an organization and they still go ahead to audit that organization. Of course, there is a difference between having financial interest as a shareholder, no matter how many number of shares you have, and engaging in normal business practices. So let's say you are the auditor of a bank and you have an account in that bank. You have a deposit in that bank. Those are normal terms and conditions. You are just a customer in that bank, and the account you have in that bank is just normal business terms. So that's normal terms and conditions. It is the relationship is at arm's length. All right. Though you still have to disclose it, but that would not necessarily impair your independence. So it's different from when you are a shareholder, when you hold shares or you're an investor in that company, or when you have taken loan from that company, or when you have granted loan to that company. Those are the kind of self-interest, that could impair your objectivity. Then another one is self-review. Self-review threat is basically when you have been involved previously with a particular work for that client, and then you're coming back to review the same work you were involved in previously. This is going to impair your objectivity. So if you identify self-review threats, for public interest entities, PIEs, you must eliminate that threat. There is no safeguard available for self-review. There is no safeguard available for self-review threats for you to reduce it to acceptable level. There is nothing like that. You must eliminate the threat completely for public interest entities. But for other entities that are not public interest entities, then you would have to identify the appropriate safeguard to use to reduce the threat to acceptable level. So you notice that I'm talking about elimination and safeguard. They are not the same thing. So when I talk about elimination, I'm not talking about reducing the threat. I'm talking about eliminating it completely. For example, you can just comfortably decline the engagement. You can comfortably decline the engagement, not to execute that engagement. That is elimination, outright elimination. All right. But safeguard could be appointing someone to supervise or review the work you have done. There is no safeguard that can reduce self-review threat for public interest entities. So, and it's important that you take note of that. Another threat is advocacy. And this advocacy threat is really a serious one, because there are instances where we as clients, we tend to advocate. I mean, we as auditors, we tend to advocate for our clients. And we do this unknowingly. For example, you have an auditor and FIRS is coming for tax audits of your client. And you as the auditor, you're going to defend your client on tax matters. There are instances where we as the auditors, we are the ones that even advise the client on tax-related matters. We'll help the client on tax planning. We help the client on so many things. So, and when you do this, if the client is eventually involved in tax litigation, you find out that you as the auditor will be involved in advocating for that client because you're defending that client. When you get involved in advocacy or you're exposed to advocacy threats, there is a risk that it is going to impair your objectivity as the auditor. And when your objectivity is impaired, of course, you cannot be independent. Then another threat is familiarity threat. Most times this arises as a result of long association with clients or where you have maintained a very long relationship with clients such that you've become so familiar with the client. There are some people that have clients that they've been auditing for the past 20 years. And those auditors, they are already synonymous with those clients. So, and some people will tell you when you have discussions with them, they will say, there is no job. So how will I just give out this one? This one I have, I'll just give it out to another person to start auditing. No, I'm going to continue to audit this client. And they have been auditing that client for the past 20 years. They will tell you it's not a public interest entity. Well, it's not a public interest entity, and we don't have a standard for entities that are not PIEs. For non-PIEs, we don't have standard for them or regulations. The regulation we have for long association is only for PIEs. But then as an auditor, the reason we have these fundamental principles and then we have these threats is for you to be able to evaluate yourself as an auditor, identify these threats, and try as much as possible to deal with them. If you are exposed to familiarity threats, your objectivity as the auditor is going to be compromised, and there is no way you would continue to be objective because you have become so familiar with the client. So you must consider your career and consider to being able to save your career, and take the right decision. All right. Of course, I understand the financial challenges aspect and trying to survive in audit practice, which is the entrepreneurial conversation that we can have sometimes. But then that is not a consideration here because I think someone is writing on the screen. I think someone is using a pen to write on the screen. So if you can please stop writing because it's affecting the screen. Okay. So as I was saying, you must consider being objective, your professional career. You must consider saving that your professional career as the auditor ahead of entrepreneurial conversations. Because once you do a very good job, you're going to definitely get good referrals. All right. So if you become so familiar with your client such that you know that it's going to impair your objectivity or your objectivity is going to be compromised, you should consider rotating from the client. And I think this is the reason why most people do not go for sole proprietorship in audit practice. And this is very, very important. So if you can merge with maybe, for small and medium practitioners, you try as much as possible to have at least 2 partners or even 3 partners in the firm. If you're a sole practitioner and you're rotating out, if you're rotating out from the client will leave your firm completely to another firm. All right. But if you have 2 firms 2 partners or 3 partners at least, then the engagement partners can rotate. If you rotate to another partner, it at least helps to protect, the financial status of the firm because you're not losing out the job completely. But at the same time, you still maintain your objectivity because you're not the one overseeing the audit. Then another one is intimidation. This threat is is a critical threat because when we talk about independence, one of the aspects or one of the areas that threaten independence so much is when the client intimidates you, intimidation. And you cannot be intimidated if you are not in a position to be intimidated. So this fundamental principle is very important. So imagine where you have a business relationship with a director of your client in another entity. So let's look at it this way. You are the engagement partner of your firm, and then you have a business relationship. That is, you invested in another company. And then another director, the director of the company where you have invested in, all right, is also the director of your clients. So I don't know if you understand what I'm trying to say here. So you have an interest in a company. The company you have an interest in, as the engagement partner, one of the directors of that company is indeed your audit client. Let me put it that way. So if you have that kind of situation, all right, you could face intimidation threats. You could face that. So you must be wary of that. And if you identify this threat such that it's going to affect your objectivity, you should be able to deal with it. All right. Then some other areas that can cause intimidation is the perceived pressure from clients. I think the last person that spoke mentioned management override, where the client in most cases put undue pressure, all right, undue pressure on the auditor. This can also cause or give rise to intimidation threats. Now let's look at other challenges. Let me start with management pressure. And this is really why I like that contribution that, that the last person that spoke, the contribution he gave, where you get undue pressure from management to do some things that are, some things that are not, supposed to be so, just because you want to maintain you want to maintain that client relationship. So let me give you an example of what management pressure can be. So imagine where a client's year end is 31st December, and they're supposed to file their financial statement on 31st March, right? Then the client made made the documents available to you. The financial statement was made available to you just about a month before sign off. You as the auditor, you have been following up with the client for a long time to make sure that those documents are made available so that you can carry out your audit, review the financial statement on time, and conclude the audit before the filing date. This was not done. Now, the client delayed until such a time when the client's timeline no longer fits into your audit timeline. But the client is mounting pressure that they need their financial statement signed because they want to file on 31st March. And you as the auditor, what can you do? Maybe you don't have a lot of clients. Maybe this is one of your highest paying clients, and you want to manage that client as much as possible. You want to manage the relationship as much as possible. If you get yourself in that position, your independence is already threatened. You are no longer independent, because what you're simply doing is you're trying to maintain that audit relationship so that you will be at least paid your audit fee. So you must find a way to deal with management pressure. All right. And then if I take it back to the conversation the other person raised earlier, where you raise propose audit journals, and the client is saying no, that they are not going to take in these journals. So when you review financial statement as the auditor, and you have identified issues in the financial statement that are not, those issues do not comply with the appropriate accounting standards or the relevant accounting standards, and the client is not willing to go ahead and address those issues. And you yourself as an auditor, you have to accept that compromise because you don't want to lose that audit relationship. So this is a very big challenge. We as auditors, we face practical challenges that we face, because when we talk about independence, it's not just by mouth. When you're faced with real issues in practice, that is when you will truly know whether you're independent or not. Okay. Another one is economic dependence, and I think I touched on it, briefly, where you have revenue concentration around one client. Most of your audit fees are concentrated on a single client or a group of clients. You cannot be independent. So this threatens your independence, your objectivity. You can't be independent when you are depending on that client. All right. So you must find a way to balance your audit portfolio such that your revenue or your audit fees are not concentrated on one client. So you must deal with that concentration risk. Okay. And then the next one is conflict of interest. And I think I've already addressed this when I talked about self-interest. All right. So this conflict of interest, they impair objectivity, and there are things you must address. So these are mainly the main challenges we see in audit practice. All right. And we have so many challenges we see, but these are the ones that impact on auditors' independence in practice. Okay. There may be other ones I may not have included in my slide, but the most important thing I want to highlight is issues of independence is a continuous process. Independence matters is not something you identify at the acceptance of the audit stage, and then you document and forget about it. No. Yes, before you accept the client, you evaluate independence for yourself and key audit team members. While executing the engagement, you still evaluate independence, and you continue to evaluate independence throughout the execution of the engagement until completion. And then when you come back next period for the next audit, you don't say, well, I was independent in prior year. That means I will be automatically independent this year. No, so you still have to continue to monitor the status, all right, to be sure that you don't have threats that could expose you or that could impair your independence. All right. Then we also have another one, complexity of standards and documentation. And then we have provision of non-audit services. Does anybody have a question? Okay. So let me quickly discuss these ones. Complexity of standards. So when we talk about standards, we are referring to independent standards. And I think that can be addressed by attending trainings like this, mandatory continued professional development, MCPD. They can help you to keep yourself updated, help you to get used to independent standards and understand them better, and then also be able to apply them in various situations. Because the truth is that you might not even know when you're exposed to independence matters. You might not know. You might be exposed by yourself directly. It might be as a result of your close family member. It could be maybe one of your children or one of maybe your wife have done some investment and they didn't tell you. And by that investment, you are directly, exposed. So you should be able to understand the nuances of independent standards and how they apply, so that when you get back as the auditor, you would be able to ask all the relevant questions, including your family, to be sure that you don't have any exposure to threats to independence. Then another one is documentation. And I think this is one of the key findings from ICAN. Being a member of ICAN professional practice, I've been involved in, reviewing audit findings. After the audit, after the review of firms by ICAN, they come back to the committee and present their report to the committee, and we review that report. And one of the things we have noted is improper documentation. Improper documentation in every ramification, not just independence, but most importantly is when they go to the acceptance file, they would not see documentation on independence considerations. You won't see it anywhere. And then you'll be wondering, how did this person consider independence requirements before they accepted the engagement? At least when you go to the audit file, you should be able to see independence considerations properly documented for every engagement team member, not just the engagement partner. Every engagement team member must confirm their independence, and this should be properly documented on file. So it's a very big challenge. Some people do not do it because of perhaps resources. Some people consider it as burdensome to them. It's a burden. They don't have the time to document other matters, not to talk of documenting audit. Why some could be as a result of resources. Maybe they feel that they do not have sufficient resources to make the right investment. But if you can at least invest in some of these, audit tools today, audit tools we have, some of them have, in fact, most of them have independence considerations at acceptance stage. All right. Throughout my audit practice, you are not allowed essentially to access an audit file if you do not confirm your independence. So confirming your independence is the very first stage, the very first thing you have to do. And this should be properly documented. And what is even more important is if a client is not eliminating, if an audit team is not eliminating a threat, and you have decided to consider safeguards to reduce that threat, you must document it. If you eliminate the threat, it could be by probably, declining the engagement. All right. If that is the process you have taken to eliminate the threat, of course, you don't have anything to document because the client is not yours again. You are not executing the engagement. But where you have considered a safeguard as the process to deal with that threat, all right, you have a threat and you have considered that a safeguard is appropriate to reduce that threat to an acceptable level. You should document the nature of that threat. You should document your considerations and how you applied the safeguard and how you were able to determine that the safeguard will reduce the threat to an acceptable level. So let me give you an example. So let's say you have indirect financial interest. You could have direct financial interest and indirect financial interest. So if you have direct financial interest is where you are the investor. So you invested in a company. And then maybe indirect financial interest could be that you invested in another company and the company is the parent of your audit client. So indirectly, you have a financial interest in that audit client. All right. Another indirect financial interest could be that your wife or your husband, your spouse, or a close family member have an interest in an audit client. All right. So if you have that kind of situation, you can decide to, especially if the audit client is not a public interest entity, you can decide to reduce the threat by disposing a significant amount of that investment such that the residual interest is not material. So if you dispose a significant amount of the investment, that is the close family member disposes the significant amount of the investment such that the residual interest is no longer material, and you still continue with the audit engagement, you should document that process, the thought process, actions taken, and how you're able to determine that this is going to reduce the threat or the threat to acceptable level. That should be properly documented. So most times you don't get to see this on file, and these are real challenges in audit practice when it comes to independence: lack of documentation and lack of evidence to support independence conclusions reached. Then another one is providing non-audit services to audit clients. This is a very big challenge. All right. So in practice, we don't just provide audit service. Firms survive because they can also do other things. So firms render audit services, they provide tax, they provide some other services as well. If you provide those services to a non-audit client, there is no issue. But where we have the issue is providing those services to an audit client. So you should be able to determine whether the services you're providing are permissible services or whether they are not permissible services. Although the rule is more stringent for public interest entities, and we're going to look at them subsequently. But I just wanted to highlight that the services we provide to our clients, in addition to audit services, are usually one of the challenges we face in practice when it comes to complying with independence, because you want as much as possible to make that money. You want to make revenue, audit fee. I mean, you want to make revenue as a firm, not just the audit fee. And while doing that, at times, you may not consider whether that is going to impair your independence or not. All right. So these are one of the challenges. Now let's go ahead. I don't know if there is any question at this point. Okay, I think we can take questions at the end of the presentation. So let's go ahead and discuss financial and non-financial relationships. So when I talk about financial relationships, I'm referring to financial interests. And when I talk about non-financial relationship, I'm referring to other relationships that are not financial interests. For example, business relationships, personal relationships, family relationships. Those are non-financial relationships. So we're going to start by discussing financial relationships. That is where you have financial ties or financial investments in an audit client. All right. Now, we've mentioned that earlier when we talked about self-interest, when we talked about threats, and we mentioned that holding a financial interest in an audit client would create or might create a self-interest threat. So that fact is already established. And when we say financial interest, we are referring to, let's say you have invested in a company, you have shares in a company, or you have investments in a company, even if it is ₦1 that you have invested, even if it's just one share you're holding, the fact that you have that interest in an audit client might itself create a self-interest threat. All right. Now, the impact on your judgment as the auditor is that you would not be able to objectively form an opinion, because any opinion you're going to form is likely going to be influenced by that your financial interest. So that's why it becomes a challenge for us. It becomes a challenge for us as auditors when we have financial interest in an audit client. So as an auditor, you should be able to sit down and evaluate the level of that self-interest that have been created. You need to evaluate that self-interest. All right. If you go to International Independence Standards, paragraph 510, it provides factors that an auditor can consider while evaluating whether the self-interest is likely going to cause, whether the financial interest is likely going to lead to a self-interest or not. So you consider the role of the individual holding the financial interest. You consider whether the financial interest is direct or indirect, and then you consider the materiality of the financial interest. Now, for direct interest, remember I mentioned direct interest earlier. If a financial interest is direct means that you're the one that is holding the interest directly as the engagement partner, as the audit team member. You are the individual holding the interest in the audit client directly. That is direct financial interest. But indirect financial interest, like I mentioned earlier, is where you have interest in another client, in another company, and the company have interest in the audit client. All right. That is, you have a family tree where you invested in perhaps the parent company or in a fellow subsidiary, and that subsidiary is related to your audit client. That is indirect financial interest. Another indirect financial interest is where the financial interest is held by a close family member. That can also be indirect financial interest. Now, what we are saying is a direct financial interest should not be held at all in an audit client. That is the requirement of International Independence Standards, which is one of the standards issued by ISBA, all right, International Ethics Standard Board for Accountants. You as an auditor cannot hold a direct financial interest in an audit client. It is prohibited. Whether the client is a public interest entity or the client is not a public interest entity, you are not permitted to hold a direct financial interest in an audit client. But for indirect financial interest, so you should be able to distinguish between the two: direct financial interest and indirect financial interest. For indirect financial interest, you should reduce it to a level that it is no longer material. If it is direct financial interest, not permitted, all of them. If it is indirect financial interest, it is only to the extent that the indirect financial interest is not material. Only to the extent that the indirect financial interest is not material, which means that you have to consider the materiality of the indirect financial interest. And how do you consider the materiality? You consider the size of that indirect financial interest compared to the size of your wealth as a whole. If it is not material to you, then you consider it not to be material. But if it is a material investment, then you need to dispose a significant portion of that investment such that the residual interest remaining would be considered not to be material. And I hope this is very clear. All right. So there are financial interests that can be received unintentionally. Let's talk about them. Something like gifts, something like inheritance. Those are unintentional financial interests. They can be received from an audit client. All right. So You might ask me, how can you receive a gift unintentionally? So it's possible. It's possible. Maybe during a festive season, the audit client decided to send something to you as the partner, just to thank you for the season, or they send something to the engagement members to thank them for a beautiful season. All right. It can be unintentional. Something like inheritance. Inheritance could be that maybe somebody that was holding interest, all right, in an audit client, and due to some reasons, the person is no more, and a will was read, and you're mentioned in that will that you'll be inheriting so number of shares from that your client. All right. It can be inheritance. These are financial interests, and they are unintentional. Unintentional means that you're already part of the engagement team. You're already rendering the service when these financial interests came up. So this financial interest, the expectation is that if they are direct interests, they should be disposed of immediately. If they are direct interests, dispose them off immediately. There is nothing to think about there. You don't even need to consider, you don't even need to think twice about it. Please sell them off. That's the requirement of the standard. But if they are not direct, remember I said direct is the one you have directly. Your name is mentioned as the beneficiary, all right? That is the direct. Any other financial interest you have that is not that direct is indirect. And for those indirect ones, the expectation is that you should dispose sufficient interest such that the residual interest will be considered not to be material. Now, if you have a situation where as an audit team member, you have an interest in an entity where a director of that audit client also have interest in that same entity, all right, then you should consider some factors. For example, consider the role of the individual in the audit team. If the individual is somebody like maybe an audit staff, all right, or when I say audit staff, that is audit trainee, maybe an NYSC staff that came for training, the role is not material, it's not going to affect the decisions or conclusion of that audit. But if the individual is the engagement partner, or the individual is the engagement manager in that audit, you can see that the role is very, very important in the conversation. So you need to evaluate the role, all right? If the role is not important in the grand scheme of things, you might not really consider it as something that should worry you. Okay? You should also consider whether ownership of the entity is closely or widely held. If you have an entity where you are the investor and that other director is the investor, so it's just the both of you that are investors there. It's different from where you have perhaps the entity is listed and you have thousands of investors. So imagine where you have thousands of investors in that entity. So if you have that kind of situation and you are just one of the shareholders, it's a relevant conversation to also have. All right. So you consider it to determine whether your interest there is significant or not. You also consider things like whether the interest allows the investor to control or significantly influence the entity. The investor we are talking about here is your own audit client. If your audit client, the interest your audit client have in that other entity is such that your audit client can control or significantly influence that other entity. So what it means is that you can be influenced, basically. That's what it means. All right? Because the director can influence the other entity where you have interest in. So all of these things are considerations you should consider. The materiality of the financial interest, you can consider them. And then the option or the way out is either to eliminate or to address the threat. You can eliminate the threat by simply removing the individual from the engagement team. If it's the engagement partner and is a sole proprietor, how can we remove the engagement partner from the team? Who will now sign the report? Are you with me? For a sole practitioner, if you identify this kind of threats, how can you remove yourself from the engagement? Who will sign the audit report? Anybody?
Yes, sir. My name is Adeleke Muiwa. I believe as a sole proprietor, there is no way he can remove himself, and the best thing is to eliminate. That is not to take such engagement at all. Thank you very much, sir.
Thank you. Thank you. So the best thing would be to just eliminate it completely. Just to eliminate it completely. And that's why we're saying that in practice, it is better to have at least 2 partners. It's better to have 2 partners. If you have 2 partners, anytime a partner is faced with a threat or conflict, what do? You move it to the other partner. So it's always better to have, things like that. It helps the firm. But for sole practitioners, it's going to be more difficult because anytime you identify this kind of threat, you don't have any other option than to completely eliminate it if the engagement partner is the one involved. But if it's just one of the audit team members, let's say it's the engagement manager, you can just simply remove the engagement manager from the team and then give it to another manager to handle. All right. So that is a way to eliminate it. That is if elimination is the way. But if you consider that addressing the threats would be the best option, especially if the financial interest is not material, you can decide to address the threats. That is, you still have the threat. You are not eliminating the threat. You still have it present. For example, it is an engagement manager. An engagement manager is the person, all right, that have that interest. And you still want that engagement manager to continue with the engagement. Then you consider maybe the financial interest is not material. So if the financial interest is not material, perhaps what you can do is to appoint another person higher than the engagement manager to review the work of the engagement manager. So that is a way to address that threat. So you can appoint another reviewer to review the work of that engagement manager. All right. So that way you are not eliminating, but what you're doing is you're applying a safeguard to try to reduce the threats. Okay. So let's look at this. As an audit team member, when you find out that a close family member holds financial interest in an audit client, what would be your consideration and how will you address the threat, if any? Anybody?
Yes, sir. Once again, my name is.
Are you not the last person that spoke?
Yes, sir, I am.
Let's hear from another person now.
Thank you very much, sir.
Yes, please. Thank you for always coming up to speak. Let's make it a democracy. Let's hear from another person, please. Another person. We have more than 150 people, 150 participants on this call. So please, let's make it interesting.
Hello.
Yes, go ahead.
If the close family member that have interest in that company is approachable, that you can discuss with him or her to dispose significant part of the shares, I think that would be a way to reduce the threat.
Okay. Maybe we should even start with what a close family member is. Is it possible that you have a close family member that is not approachable? If that person is not approachable, that means the person is not a close family member now. Don't you think so?
Yes, yes. Okay, let me just remove the word close. If the
No.
family
What the
member,
standard said is close. It's not
okay,
every family member. It's the close family member. That's what the standard says.
we should approach the close family member to dispose significant part of that shares in the company. So that is one way
Okay.
to reduce debt.
Okay. Thank you very much. Although what you answered is how to address the threats. I would have loved to also hear considerations. For example, when I say considerations, um, you know, what are the things you will need to think about before, at least before you arrive at this safeguard you just mentioned, which is disposing it. There are things you would have considered. What are those things you will consider first before you start talking about how to address it?
Alyssa,
Yes, please.
I think the first thing that
I can't hear you again. I don't know if it's my
sorry, sir.
network.
No, a call just came in, so I have to. So I think the first thing that one needs to determine is if the interest the close family friend actually has is significant. Let's assume it's like a financial company that deals with shares. You have to determine the amount of that interest that that person has. If it's not significant, maybe 0.05% interest or 1%, it cannot actually affect your own work at that, your own audit work. So I think there might not really be a bigger issue, but unless if the interest is actually significant, that is when you can now approach that family friend, or you actually remove yourself from actually the audit team. So it could be one of those two options, sir.
Okay. Thank you. Thank you very much. Is there another person that wants to speak before we go ahead? Okay, so let's run along because of time. So the factors you would consider, you will consider the nature of the relationship between the audit team and the close family member. Whether the relationship is such that the close family member can influence the decision of the audit team member. All right. So you consider that relationship. For example, if it's your spouse, you consider the relationship. Is it such that, the kind of relationship you have with your spouse, is it such that your spouse can influence the decision, your own decision, as the audit team member? You consider the nature is very important. Then consider whether the financial interest is direct or indirect. When I mean direct, whether that your close family member is holding direct financial interest in the audit, in the client, or perhaps your close family member have interest in another entity that then have interest in that your audit client, making it indirect interest. So you have to also consider that as well. Then you consider the materiality of the financial interest, to the close family member. Consider the materiality as well. So if you consider all of these factors, based on whatever is your outcome, you can decide to eliminate the threat. So you eliminate the threats by asking the family member to dispose the interest, let them sell it. Or you can eliminate the threat by removing that audit team member, that individual, remove the person from the engagement team. All right. Or you can appoint an appropriate reviewer to review. That would be the safeguard to reduce it. So it's either you eliminate or you address the threat. If you eliminate the threat, it doesn't exist again. But if you still want the auditing member, maybe the guy is very good in audit and you want a skill in that audit, you don't want to lose him, you can as well just appoint another person to review the work of the auditing member, and that should suffice, especially where it is not material. Now, let's talk about business relationship. So for business relationship, we are referring to a situation where you have a joint venture arrangement with a client, all right? Or you accept to sell or resell or distribute or even market your client's products or services. That is business relationship. So let's say your client sells, your client is involved in selling, what am I going to use as an example? So let's say that your client is selling books. And then when you went for it, you picked some books, you went back to your office or to your location, and then you're marketing the books to your people. All right, that is business relationship. Or where the client is assisting you to market your own business. You have a mutual relationship where you accept to help the client to market their business, while the client is also assisting you as the auditor to market your own audit business. So that is business relationship. Or you have an arrangement where your firm is licensing the product of the client, where your firm is licensing the product of the client or certify the product of the client, that the product of the client is okay. Maybe your firm have IT department and your client is involved in IT solutions, and then you certify that solution to say that it is okay, or you license it. So if you have all these kind of relationships, these are business relationships, all right? They are not financial interests directly, but they are relationships that can create self-interest. They can create self-interest. They can even create intimidation threats. All right. So the requirement of the standard, international independent standards, is that a firm or an audit team should not get involved in a close business relationship with an audit client or even its management. All right. Unless the financial interest or any of such interests you have is immaterial. So the expectation is that don't even get involved in the business relationship at all, unless the business relationship is insignificant to the firm, or the financial interest that will arise from that business relationship is immaterial, or the financial interest does not give the investor or the group of investors ability to control the closely held entity. So all of these are considerations you have to, things you have to consider before deciding whether you should accept or not. So the expectation is that don't even do it at all. But if you have to do it at all, then it should be because the relationship does not lead to a material financial interest, or that the business relationship is not significant to you as a client. The next one is family relationship or personal relationship. If you have personal relationship or family relationship with a client, it might create self-interest, or it might create familiarity or even intimidation threat. So, and the impact is that it's going to impact the auditor's ability to make biased decision. It's going to impact it, thereby impacting independence. So the auditor cannot be independent because we have personal relationship. All right. So you have to consider the individual's responsibility in the audit team. Also consider the role of the family member. All right. Then the best thing to do is eliminate it if you believe that elimination is the way to deal with it, especially for non-PIEs. for public interest entities, eliminate it. But for entities that are not public interest entities, because you know why I always distinguish between public interest entities and non-PIEs. For public interest entities, PIEs, expectation when it comes to independence is heightened. The expectation is very high for public interest entities because you have the wider public interested in that process. And you also have regulators reviewing the audit process. So for public interest entity, you have a wider expectation. But for non-PIEs, the expectation is not high. And that is why for non-PIEs, you might decide not to necessarily eliminate it, but you try to address the threats. Not that you ignore the threat, you can address the threats. And the way you can address the threat is you structure the responsibility in such a way that the audit team member does not deal with matters that relate to the responsibility of the audit team of the family member. All right. So let's say that the director of your audit client is involved, or okay, let me not use audit and director. Let me use, let's say manager. You have a manager finance. That manager finance of your audit client, all right, finance manager of your audit client is related to your audit senior. Let me paint that relationship. Your finance manager of your audit client is related to the audit senior. Now, the finance manager, the work of that finance manager is to deal with PPE, property, plant, and equipment. The finance manager is responsible for anything that has to do with property, plant, and equipment in that company. Then the way you can address the threat is to say, this audit senior will not work on anything that have to do with property, plant, and equipment. That way, you address the threats, all right? But for public interest entities, you cannot address the threat, just eliminate the threat by removing the person from the engagement and assign the person to another engagement, okay? Now, let's talk about non-audit fees and reliance on non-audit fees. I mentioned non-audit services earlier, recruiting services. We are all practitioners. Have you ever helped your client to employ somebody before? I know some of us are I know some of us are guilty of this one, right? Even if you don't help in the direct recruitment, you help in structuring the JD, the job description. Have you helped in structuring the job description of a CFO of your client? In fact, there are some people I see, they post, there are some, in the WhatsApp, in the district WhatsApp, not our own district, the districts I belonged before, you will see some people, they post job adverts to recruit somebody for their audit clients, and they're involved in the interview. They're involved in the whole process. They're involved in structuring the JD. They're involved in, in the entire process. That is non-audit service. Accounting and bookkeeping services. Do you help your client to keep records? Some auditors do this. So IT services, internal audit services. Some auditors also render internal audit services to their clients. Valuation services. Yes, some auditors also render tax services. In fact, that of tax is the one that is prevalent. Some auditors render, in fact, not some, most of the auditors render tax services to their clients, their audit clients. What makes it to be non-audit services? The fact that you're rendering it to an audit client. If you're rendering it to another client that is not audit client, there is nothing to worry about. The fact that you're rendering the service to an audit client is what makes it to be a bit of challenging. You provide advice and recommendations. You provide litigation support services. These are non-audit services. The question is, which of these services can you really perform for your audit clients. Is it all of these services that are prohibited? That is the question. And the starting point is to evaluate whether you are exposed to any threats. That is the starting point. If I talk about recruiting services, it depends on who you are recruiting. That's what will determine whether you're exposed or not. If you're recruiting CFO, you're automatically exposed. You know that. If you're recruiting anybody that is involved in finance and accounting function, you are exposed because you're going to be reviewing the work of that person. So you're definitely exposed. But if you're helping to recruit an engineer, you're helping to recruit a business manager who is not directly related with finance functions, then you can conclude that you are not exposed. All right? Then another thing is the fee you are collecting from the recruiting service. All right, is something that is expected that you disclose it, especially for public interest entities. Any non-audit service you render, the fee you have collected is expected to be disclosed, especially for public interest entities. For accounting and bookkeeping services, what is really the nature of accounting service you can render as an auditor? The truth is that you cannot render any of them. You cannot render any of them. For public interest entities, you are completely prohibited. But for entities that are not public interest entities, you can only help to the extent of help assisting the client to compile a statutory financial statement. Hello, I hope you're there. You can only help for entities that are not public interest entities. You can only help to the extent of you assisting the client to compile the statutory financial statement. And statutory financial statement means that you're simply assisting the client to put the financial statement in a manner that can be published, which means you're dealing with historical information. You are not involved in how that information came about. The client have processed all their information. They posted everything in their everything in the journals. All the journals did not come from you; it came from management. All the please can we all be on mute? I'm hearing a lot of noise. All the journals did not come from management. You did not make any of the entries. You did not record any of the entries, right? You did not post any transaction. Management did all of that, and they generated the records for you. So what you have is historical information. You can assist them to compile it in a statutory form, but that is only for non-PIEs. You cannot do it for public interest entities. Very important. All right? IT services, you're prohibited from rendering IT services to your client, whether public interest entities or non-public interest entities. You are prohibited from rendering IT services because these IT services are systems that are used for, for financial reporting. So effectively, they are going to affect the financial reporting process. Internal audit services, you're prohibited. Valuation services, you're prohibited because the valuation service will eventually go into the financial statement and you have to review it. So you're prohibited. Tax services. For tax services, what can you do as an auditor? Well, you can do tax return preparation. You can do tax return preparation. That is the only thing you can do as an auditor. Tax return preparation is simply assisting the client with the historical numbers. You are not the one calculating the tax that will be paid. There is difference between tax return preparation and tax calculation for the purpose of preparing the accounting entries. Tax calculation for the purpose of preparing the accounting entries, the one you post in the financial statement, you cannot do it as the auditor. But when management have agreed on the tax that should be paid based on the laws, the tax laws, they have calculated the tax and they've agreed on what can be paid, you can assist to file the return. So by assisting in filing the return, you are not exposed to any threat because you are not going to be reviewing any figure that you came about yourself. I hope you understand that. You cannot render tax advisory service. You cannot render tax planning service for your client, audit client. Please, can we stay on mute? Someone is unmuted, and the person is discussing in their office. There is someone that is not muted, and the person is discussing in their office. There is somebody that is not muted, and this person is discussing. So, admin, can we go through and maybe
who is this person, please?
Assist to mute them. There is somebody that is not muted.
Okay, Basi is not muted. I'm trying to mute him.
Okay.
Thank you.
Okay, so let's continue. So all of these other services, tax planning services, tax service involving valuations, assistance in the resolution of tax disputes, you're prohibited from rendering them. If you assist in resolution of tax dispute, it's going to put you in the position of management. You are going to assume management responsibility when you want to do this. So you are going to be exposed to advocacy threats. You're going to be exposed to advocacy threat. All right. So you can see that all of these services will expose you to one threat or the other, either to self-review threat or self-interest threat, which is conflict of interest, or advocacy threats. Any of these are likely to expose. The only one that you can really render, the only service you can render here that will not expose you to any threat is tax return preparation, which that one simply means that the client have done their calculation. Maybe in your own audit firm, you have someone that have the skill of going to tax promas, upload all of those documents and all of those things. But it's not the person that did the calculation. It's not the person that posted it in the financial statement. The client did all of those things themselves, and they've arrived at the numbers. They're simply asking you to, even at that time, you have even signed the financial statement. They're simply asking you to please help us to file this. There is no exposure there. So you can assist to do that. But anything that has to do with the number in the financial statement, which you, the auditor, is expected to review, you are not permitted to do that. You are not permitted to render administrative services. Although administrative services, it depends. If it's something like company secretary, if it's something like company secretary, I know there are some auditors that assume the position of company secretary for their clients. Now, if you go to CAMA and check for the qualification of company secretaries, CAMA states that a chartered accountant can also be or practice as a company secretary. The question now is, can you as an auditor be the company secretary of an audit client? For public interest entities, it is prohibited outrightly. You cannot do it for public interest entities. Now, for non-PIEs, you will have to evaluate the level of your involvement as a company secretary. You have to evaluate the level of your involvement as company secretary. You know, when we say these things, we probably just play them down, but there are some auditors. You know, when we talk about the position of company secretary, there are some auditors that assist their clients to file returns with CAC, Corporate Affairs Commission. And when they file returns with Corporate Affairs Commission, after filing the returns, they usually sign off because they are accredited agents, they usually sign off as company secretaries. Some people do that as well. Are you really permitted to do it? I said for public interest entities, no, you are prohibited. But for non-PIEs, you evaluate the level of your involvement. So if the level of your involvement is assisting with filing of returns only, assisting with filing of returns only, which means you don't participate in board meetings, you don't take minutes of board meetings, you don't make contributions at board meetings. That is, participating in board meetings, not participating in board meeting as auditor. What I mean is you don't participate in board meetings as a company secretary. If you don't do that, it's fine. So if your responsibility is limited to just helping them to file returns, just like we talked about for tax, if your responsibility is limited to just helping them to just file returns, right? Then that is an acceptable level of threat that can be dealt with, that can be managed for non-PIEs. But for public interest entities, that cannot be managed. You cannot do that. You're prohibited. Now, like I mentioned, the worry about this non-audit services is that there is a risk that when you render non-audit services to an audit client, you assume management responsibility. And what do you mean by management responsibility? It involves controlling, leading, and directing an entity, including making decisions regarding the acquisition, deployment, and control of human, financial, technological, physical, and intangible resources. That is management responsibility. When you render non-audit services, you indirectly expose yourself in such a way that you're assuming these management responsibilities. And when you assume management responsibility, you expose yourself to those threats we already talked about. So before accepting an engagement to provide a non-audit service to a client, to an audit client, you need to first of all identify whether there is any threat, evaluate the threat, and address any threat to independence. All right? Threats might be addressed by applying safeguards. If when you apply some safeguards, like we discussed earlier, you can address some threats. For PIEs, you are not expected to provide non-assurance services to an audit client that is a PIE. I mentioned that earlier. And that is because it's going to lead to these threats. If you have self-review threats, for example, self-review threats arising from non-audit service cannot be eliminated for public interest entities.
Huh?
Yeah. It's like the person have unmuted again. So self-review thread, let me run. I can see my time is almost over. Self-review threads cannot be eliminated for non-audit services, all right? Especially for public interest entities. They cannot be eliminated through safeguards. That's what I actually mean. So you can't reduce them to safeguard. I mean, you cannot reduce them using a safeguard to an acceptable level. So you just have to eliminate them. So I'm going to correct that before I send the slide to you. So for non-audit services, rendered to public interest entities, you cannot address them through safeguards. All right. What is expected is that you should only eliminate them. However, if a non-audit service is required to be rendered to an audit client by regulation, for example, ICFR, in Nigeria, audit clients are permitted to provide attestation reports on internal control over financial reporting for audit clients. In Nigeria, auditors are permitted to provide attestation reports, that is, render attestation service for the review of internal control over financial reporting for an audit client. They are permitted to do that in Nigeria. And that is from the Financial Reporting Council, the Financial Reporting Council guideline, which they issued that became effective for in 2024 for non-PIEs, I mean for PIEs, for other PIEs other than listed entities. And where you have accepted the responsibility to render a non-audit service, ISBA requires, especially for these public interest entities, ISBA requires that you should communicate that to those charged with governance. And when you communicate to those charged with governance, you need to establish the appropriate threat level, if at all you're exposed to any threat, and then address it. So all of those communications should go to those charged with governance. All right. And then the expectation is that for the safeguards, if you want to use safeguards, you can use professionals who are not assurance team members to perform the service, or you can have an appropriate reviewer. But for elimination, you can adjust the scope of the service such that it will eliminate the circumstance, or you can just decline the engagement outrightly. All right, you can end the assurance engagements. So these are the ways you can simply just eliminate them outrightly. I don't have time again. I can see that my time is almost over, so I'm now running. So let's go to tenure restrictions, and I'm going to rush on this one. So for tenure restrictions, what we are saying is that if an auditor is involved in long association with an audit client, is going to expose them to familiarity threats and self-interest threats. So in order to address these threats, you need to follow ISBA requirement for long association. For public interest, ISBA requirement is applicable to PIEs only. It's not applicable to non-PIEs. So it's applicable to PIEs. The expectation is that if the engagement partner have served for a period of 7 years, the engagement partner should rotate out. So if you have a firm that have 2 partners, 3 partners, that engagement partner should rotate out and hand over to another partner to continue. All right. And when the engagement partner rotates out, the engagement partner can cool off for 5 years before they come back. Cooling off means during that period of cooling off, they cannot be consulted. They cannot act in any capacity on that engagement. They cannot render any service for that engagement. They are completely out of that engagement for a period of 5 years. All right. If someone have acted as EQR cumulatively for a period of 7 years, they are required to cool off for 3 years. If somebody have acted as key audit partner for a period of 7 years, they are required to cool off for a period of 2 years. Key audit partner means any other partner on that engagement other than the signing partner. You know, you can have 2 or 3 partners on a particular engagement, depending on the complexity and the nature of the engagement. If an engagement is so big, you can have 2 partners. One is the engagement partner, who is the signing partner, and the other partner would be the supporting partner. So if you have a supporting partner who is a key audit partner, and the partner have worked on that engagement cumulatively for a period of 7 years, ISBA require them to cool off for a period of 2 years. But here in Nigeria, we have our own FRC audit regulation. And our FRC audit regulation require firms to rotate out after 10 years. So after 10 years, you rotate out and you cool off for 7 years. But if it's joint audit, rotate out after 15 years and you cool off for 7 years. For engagement partners, you rotate out after 5 years. For public interest entities, remember, FRC audit regulation 2020 is applicable to public interest entities. The whole idea about this is just to manage that independence. So you don't get to a level where you become so familiar, so comfortable with the client that your objectivity and your independence will become impaired. Now you can see that FRC regulation require partner to rotate out after 5 years, but ISBA regulation require partner to rotate out after 7 years. So we are expected to comply with FRC requirements because FRC requirement is more stringent, right? So we have to comply with the requirement that is more stringent. That of ISBA is not stringent. 7 years is too long, but FRC is saying after 5 years, you rotate out for public interest entities. It is expected that you comply with regulations to avoid sanctions. So I'm not going to, because of time, I'm not going to waste a lot of time here, but just to mention that as an auditor, you have a responsibility to comply with independence requirements and regulations to avoid penalties, because this time around, ICAN is going about reviewing firms, all right? And FRC is also going about reviewing firms that are involved in the audit of public interest entities. So to avoid penalties, which is a consequence of non-compliance, it's expected that you comply with these independence requirements. Now, why do you need IT? In terms of technological advancements and innovations, you need IT to help you track conflict of interest. Like I told you, my own firm and even the firms I've worked with before, we have a tool that we use to log in any interest. For example, if I buy shares now, we'll go and log it there, that I have shares in this entity. So what that tool does is that it has a database of all the employees with the shares, all the shares they have, such that if you have any share, you will not make the mistake of being appointed to serve on an audit engagement where you have interest in. So that's why it's important to have IT tool that can assist to track all of these things, especially if the firm is very big. It's important to have an IT tool that can help you to do that. Otherwise, if the firm is not so big, Excel can just simply help to maintain database of all your investments, So, and then of course, you need to document independent decisions and conclusions reached by the engagement team. You also need to have a tool that can help monitor partner rotation. There are some firms that the partner will do 6 years, 7 years, 8 years on PIEs, but they will not know. But if you have a tool that helps you to track the period you have spent on a particular engagement, it will help you. And when you are in the 4th year, the tool will send you a mail or flag you to say, this is your penultimate year, and you're about to enter your final year. All right. Once you're in the 5th year, the tool will remind you that after this year, you cannot continue, such that after that year, you hand over to another, you rotate out and hand over to another partner. But if you don't have a tool that can help you to manage this partner rotation, you're likely going to fall into that temptation of overstaying. And when you overstay, you'll be sanctioned by the Financial Reporting Council. All right. This tool can also help you. Those tools can also help you in terms of artificial intelligence and machine learning. They can help to manage the data, and then determine whether there are issues of, independence or not. And then they would, highlight or flag those issues. All right. In terms of data analytics, if you want to analyze all your investments, this tool can assist in data analytics. The tool can also help you in terms of digital work papers. So in fact, most of the audit softwares these days have digital work papers where you can carefully document your independence decisions. All right. So now let me move on to independence considerations. What should you consider? At the point of acceptance, you need to consider independence and reach a conclusion before you accept the engagement, and that should be documented. While you're performing the engagement, you need to confirm your independence before the commencement of that engagement. That should be documented. If you are performing the engagement, throughout the period of performing the engagement, if you need to continue to monitor your independence, all the engagement team members, before even start planning, they must confirm their independence. And then if there are safeguards you have used to reduce the threat to any acceptable level, that should be properly documented. I've included an example of a documentation process. You can have something like this on Excel. So when I share the slide with you, if you're a firm where you don't have some of these processes, this is a very good guide you can use. So you can have these questions on Excel, right? And then you simply answer with yes or no. For example, have you been previously employed by the audit client? And have you provided services to this audit client as a contractor, a third-party service provider in the past? All right. You answer yes or no. All right. Have you gone on a trip or attended an event with this client such that the trip will require perhaps non-local travels or overnight accommodations? And then the purpose of this trip is for events such as social, leisure, entertainment. That's the nature of such a trip. Have you embarked on such trip before? You answer yes or no. So all of these questions can be documented. So if you answer yes or no to all of this. All the engagement team members will answer yes or no, yes or no, yes or no, to all of this. Where you answer yes, you provide the safeguard you have used to reduce the threat when you answer yes. So if you have all of these questions on Excel, I have more of them here. You answer yes or no, then you have them in your audit file properly documented. This is a very good example of independence documentation at the point of commencing your audit. I've already mentioned stakeholders' expectation, especially for public interest entities. The stakeholders are expecting unbiased audit. The stakeholders are expecting us, they trust us as auditors. They're expecting us to be honest. They're expecting us to do our audit with integrity. They expect us to comply with ethics and independence standards. And they expect us to be transparent in our communication. And that's why auditors are expected to release transparency reports, all right, especially auditors that audit public interest entities. Financial Reporting Council Rule 12 require you to release transparency report. In that transparency report, you're expected to be transparent in describing in detail how you have complied with, that is, you describe your independence policies in the firm and how you have complied with all the independence policies. You have to describe all of them in your transparency reports. So in summary and conclusion, just to say that independence is important, and where you have it in your firm, when you have a threat, you need to identify those threats and address them as appropriate. You need to embrace technology. Audit tools are very good in helping you to document, not just documenting independence, tracking conflict of interest, tracking your investments, and make sure that you are not exposed. So all of these tools will help you to do that. And then just to find on a final note to say that stakeholders are expecting so much from us as auditors. So let us continue as much as possible to be independent, carry out our audit objectively, carry out our audit with integrity. And that brings us to the end of the presentation. So I will now listen to see if there is any question so I can take them. Thank you very much.
Thank you very much, Dr. Chinedu. It's been a wonderful presentation. You have not only dealt or give a blow to the subject matter, you have also destroyed it by bringing it down to granular. We thank you very much. Can we now have question and answer? Because of our time, so that the previous presenter can attend to all the questions once at a time. Hello? Hello?
So, I want to
Question, please.
Question. I'm asking a question.
Dr. Chinedu, can you hear me?
Yes, I can hear you.
Thank you very much. I'm expecting questions from the participants. We have over 150 plus on this platform.
Okay, what we do, if you have questions, just raise your hand electronically, and maybe we have like 5 or 6 questions, then we can now call them. So raise your hand electronically, just put it up, and then we call on you and you ask your question.
Thank you, my chairman.
Okay, go ahead, Mr. Abdulaziz Yusuf. Your question.
Hello. Good afternoon, sir.
Good afternoon.
Please, I would like to know more about the as regards the presentation. So there was a particular point where it talks about being where what happened if the auditor gets what happens if an auditor has gets to have a familiarity concern in an audit environment? So it talks about familiarity, threat, and conflict of interest. I understand that part of familiarity traits, but as for the conflict of interest, I think I need more explanation on that part, sir.
Okay. Are we
Okay,
taking
let
all the
us.
questions at once?
Okay, yeah,
I
better.
think it's
Mr. Michael.
better.
Okay, unmute and ask your question.
Okay. Good afternoon, sirs. I appreciate Doctor for that elaborate lecture. My question is going about the internal control, internal auditor, right? As regards their independence, as I've said, as regards our work, we are in having raised some fundamental principles to follow, and you are being told that just leave that one, don't worry about that, you will know how to handle that. In this case and others like that, what can be done to protect the independence of an internal auditor in a company, apart from our external auditors, to get the work done accordingly and in accordance with the standard and of the institution? Thank you. Hello.
Yeah, doctor, you can go ahead to answer the question since we have only two. So
Only two. Okay. I thought another person wanted to ask. Okay, that's fine. So the first person spoke on asked about conflict of interest. And I think maybe the person probably joined a bit late because we started with discussing the conflict of interest. So let me recap. Conflict of interest is one of the challenge we have in as auditors while trying to comply with auditors with independence requirements. And the reason is because we have a lot of nuances that we need to, I mean, as an auditor that is practicing in Nigeria specifically, there is the financial aspect of it. And this financial aspect of it could make you, it could expose you to those financial interests. All right. You might have a very good investment opportunity advertised to you, but you didn't know that it's going to expose you to anything. So you just thought that it's good for you to invest. You invested only for you to eventually find out that your investment is connected with your audit client. So at some point, it's as if auditors are not expected to grow their wealth. In fact, that's one question I was asking myself at some point, asking us to always dispose your investment, dispose your investment, dispose your investment. Does it mean that we are not expected as auditors to grow our wealth? Which means when you make your money, maybe you just put it in the bank and just leave it like that. Because if you are working in a very big, bigger firm, you're going to be exposed to some of these conflicts, to be honest. But that's not what we are saying. Yes, auditors can grow their wealth, but you have to grow your wealth in a smart way. You have to grow your wealth in a way that is not going to affect or impair your objectivity. So if you have investment in an audit client, either direct interest or indirect interest is going to lead to conflict of interest. All right. If you get involved in self-review, maybe you have rendered non-audit service before, and you are also, as the auditor, reviewing the work you have done previously. it will still lead to conflict of interest. So all of this are going to lead to conflict of interest. So conflict of interest on its own is not necessarily a threat, it's a challenge auditors face while trying to comply with independence. But the threat itself is the self-review, which is a form of conflict of interest. Self-interest itself, self-interest threat, is also a form of conflict of interest. So when you're exposed to this conflict of interest, you need to find a way to either eliminate the threat or reduce it to an acceptable level. And I think that's the summary of what we have discussed about conflict of interest. And then for the second question on internal audit, the person is asking, how can we protect the independence of internal auditors? How can we protect the independence of internal auditors?
Very difficult. Because I have been in it before, so I know.
So I don't know how to answer that question. And the reason I don't know how to...
My chairman, you also laugh me.
The reason I don't know how to answer that question is because the person that is paying you salary as an internal auditor, the person that is paying you salary is the person you're reviewing. So I don't know how you can be independent, but I know you can comply with fundamental principles.
Yes.
An internal auditor can be objective. Objective in the sense that you can carry out your internal audit while complying with ethical code and also comply with management policies. Every company should have a policy. So as an internal auditor, to the extent that you're rendering your internal audit service while complying with management policies, I think you will be fine. But for you to be completely independent of management, I'm not sure we can have that conversation here because it depends on the management, really. I know internal auditors are supposed to report to the CIA, Chief Internal Auditor. The Chief Internal Auditor reports to the Audit Committee directly. That is the board structure. But in practice, I'm not sure I've seen it work in practice. And management is the one that's supposed to pay you salaries. So maybe what I can say is, as an auditor, as an internal auditor, try as much as possible to comply with the ethical code by being objective. Be objective while discharging your responsibilities. Try to have that professional behavior. Discharge your responsibilities with integrity as much as possible and comply with management policies as much as possible. And when you have issues, you can escalate to the appropriate authorities. So I think that's the best way I can respond to that. And any other person can feel free. I mean, all of us are members in practice. So if you have any other way you think we can achieve this, auditors independent or protect auditors while in employment, that is internal auditors while in employment, please feel free. Feel free to also add your voice.
Thank you, sir.
Okay. Thank you, Dr. Sinedu. Let us allow Mr. Olufemi Bello to ask his question, then we do the closing protocol. Mr. Olufemi Bello.
Thank
your
you. Thank you, Dr. Abe. Although I put the question on the chat, what I want to ask Dr. Shinedu is that, don't you think, and every one of us on this platform, don't we think that this audit assurance is being over-regulated? ISBA is coming with something, PAOs are coming, financial reportings are coming, everybody is coming with one thing or the other, and on to the same assurance, audit and assurance and other services. To me, I think we are overplugging this thing, and I think it will get to a stage where people will be afraid to enter into this profession. So this is my taking. Over to you, Dr. Shinedu.
Okay, Mr. Olufemi Bello, nice to hear from you. I think it's been a long time. I've worked in a committee with you before, ICAN committee. So yes,
You are very right. You are
yes,
very right.
I understand what you're saying with respect to being overregulated. But you know, this is our audit practice. I think I talked about stakeholders' expectation earlier on. The stakeholders' expectation is too wide for us, the auditors. The expectation is so huge. What you're expected to do, and if you are not careful, the expectation can put us in problem as auditors. All right. If if a client have issue, the very first question they will ask is, who are the auditors? I remember when a bank failed in the UK about 3 years ago. That should be in 2023. No, 2 years ago. Um, if I'm not mistaken, is this Silicon Valley Bank also? The first question everybody started asking was, who are the auditors? Who are the auditors? That's the very first question to ask. Nobody's even thinking, when Heritage Bank failed in Nigeria, when CBN, I think it was sometime last year, sometime in June last year, they said Heritage Bank has been liquidated, handed over all the assets and liabilities to NDIC. If you go to social media, the question people were asking was, didn't the auditors see it? Didn't the auditors give clean bill of health? The last opinion they issued? That's the question. Nobody is even asking, what is the scope of your audit? Nobody is even asking, do you have emphasis of matter paragraph? Nobody is even asking, did you include material uncertainty related to going concern in your Nobody is even asking all those questions. This question they're all asking is, didn't the auditor review, see this? Didn't the auditor say something? So because of the heightened expectation for us as auditors, I don't think the audit profession can be overregulated. I don't think so. And the reason I say that, I'm saying it with all, responsibility. And the reason I say it is that if you don't regulate it, it's going to be free for all. A lot of things will start happening. And then for the independent standards we have discussed today, these independent standards are not new. These independent standards have been there. A lot of all these issues I discussed today, I don't think there is any of them that is new, except maybe the audit regulation that came up in 2020, which is now 5 years ago. So I've not discussed anything today that is completely new. And I can only say that for us as auditors, let us try our best to comply as much as possible. I understand the nuances of complying, but let us as much as possible try to comply. I encourage you, please don't run away from our practice, our beloved practice, because when we run away, who is going to do this job? There are so many jobs to be done. Who will do them? So please, let's run away. Let's put our hands together and try to grow this profession, this our wonderful audit profession. Thank you.
So thank you so much, Dr. Shiredu. I think, Mr. Nidayo, so kindly drop your questions so that our speaker can attend to it. We can revert back to you. We don't
I've
have
actually dropped
time.
it, sir. I've actually
Okay.
dropped it, sir. So I raised my hand just to call attention to my question. Is in the chat box.
Okay. I will reply. We don't have time. We're supposed to have ended by 1 o'clock, at
All right.
least,
All right, sir.
18 minutes after. Okay. Thank you so
Thank you,
much.
sir.
Let me hand over back to the chairman of the committee, Mr. Oyenuga.
Thank you very much, my great chairman, and thank you very much, other school members on this platform. Thank you very much, all the participants, and very thank you so much to our doctor who has presented this paper. It was well elucidated. Every content thereon were properly discussed and even broken down to granular. according to the synopsis of the paper. Once again, I want to thank you very much. It's a pity that we don't have the time. Otherwise, I would have just run through all the major areas that I've mentioned. However, my chairman has mentioned some of them in his remark. Once again, I want to thank you all for your participation. And I will hope that next time when we call you, you'll be able to answer us within the tickle of an eye. Without missing words, my chairman has done a lot of things and he has actually taken a lot of things into consideration. So also the paper presenter, Dr. Chinedu, for answering the questions that were posted and also as agreeing to send some answers to the question that could not be answered, either due to time factor or probably the questions were coming very, very late. On behalf of this committee, I say a very big thank you. I think that's all I have to say, my chairman, sir. My chairman.
Okay, thank you.
Yes,
The next item before closing is presentation of token, not money anyway, to our paper presenter. This will be handled by our past chairman, Professor Godwin Emmanuel Oyedokun. Professor, kindly do justice to
Yes,
that. Yeah,
my
over to
chairman,
you, sir.
sir. I want to come. My chairman, sir, permit me to appreciate God in your life for this feat that we have achieved today as well. And by extension, those that have occupied this position before you, right from our pioneer chairman, who is also a council member, Dr. Omidiji, and Alhaji Dr. Bisiriyu. I'm not called to come and give vote of thanks, but to appreciate Dr. Chinedu. I took my time to listen carefully. I will have started asking questions, but I don't want people to know that I don't know book. That's why I did not ask him any question. Okay, so Dr. Chinedu, you have done well, and you have not disappointed your son name. Thank you so much for your time with us. I noticed when somebody was trying to scratch the screen, I saw that spirit in you that didn't like anything that is not good. Yeah, that's the way I also behave. And you did not also allow it to affect you. You continued, and in fact, if not because of the time, they ask you to continue, you still have so much to say. Thank you for breaking this down for us, and thank you for finding time to be our guest speaker today. One of the issues we have in our district is that unless you are not good, we will come back again and we'll be looking for you. Please don't close your door. Certain other topics will come. So the award is being projected, and on behalf of the executive and chairman of our business society, we present to you a special award for serving as our speaker today in our training, Tag Members in Practice Committee webinar training. Thank you so much. And the add value of it will get to your office in due time. God bless you. And we pray for more wisdom from above. Thank you, sir.
Thank you very much. Thank you to you, and thank you to the leadership of the district. As I mentioned when I started, I am now a member of the district. So I'm happy. In fact, I'm home, being a member of the district. So I look forward to more collaboration and, to try to enhance our knowledge as much as possible. Thank you so much. And I sincerely appreciate this opportunity and the award. Thank you.
Thank you so much. Chairman, over to you, sir.
Okay, thank you so much, ladies and gentlemen. As we have concluded the webinar today on auditors' independence and financial integrity, I would like to once again sincerely appreciate our presenter, Dr. Shinedu, and the anchors, the membership in practice committee of IGDS. I really appreciate you all. We have explored some key challenges auditor faces in the maintaining independence and upholding financial integrity. You know, an issue that is more relevant than ever in our evolving regulated and ethical landscape. Well, you know, the discussion today have not only highlighted the complexities involved, but also emphasized the crucial role of continuous vigilance, ethical conduct, and professional judgment in audit practice. Let us take the insight shared today by our erudite doctor to action and to enforce integrity, ensure objectivity, and uphold public trust in our profession. Thank you once again for your active participation. Stay informed, stay ethical, and stay independent. At this time, the webinar is hereby put to close. Thank you and God bless.
Thank you, my chairman.
Yeah, thank you.
Yes,
Thank
sir.
you. Thank you.
Bye.
Thank you. Bye.